Welcome, and thank you for embarking on this deep dive into interest rate swaps, the true foundation of the fixed income derivatives world. Over the course of these modules, we will move beyond textbook definitions and equip you with the practical professional skills to not only understand, but also to confidently value and manage the risk of these essential financial instruments. This knowledge is crucial for anyone aspiring to a career in trading, corporate treasury, risk management, or investment analysis. We'll start with the core concepts, build the valuation framework from the ground up, and then apply it all in hands-on exercises, including a practical Excel model that you will learn to use yourself. So, let's begin by answering the most fundamental question. What exactly is an interest rate swap? At its heart, an interest rate swap is a privately negotiated derivative contract. It's a promise between two parties, whom we call counterparties, to exchange or swap streams of future interest payments over a specified period. These payments are calculated based on a predetermined underlying value, known as the notional principal amount. It's critical to visualize this not as a loan, but as a series of interconnected promises about interest rates. One party agrees to make a series of payments calculated using a fixed interest rate, while the other agrees to make a series of payments calculated using a floating interest rate, which resets periodically based on a market benchmark like SOFR or TLREF. The beauty of this structure is its flexibility, allowing institutions to transform the nature of their interest rate exposure without having to issue new debt or change their underlying assets. Let's now break down the anatomy of the most common swap structure, the plain vanilla fixed for float interest rate swap. This is the fundamental building block of the entire swap market, and understanding its two distinct payment streams is essential. The entire contract is built around the exchange of these two streams, which we call legs, based on a notional principal that is never actually exchanged. On one side, you have the fixed leg. As the name implies, this leg consists of payments that are predetermined and unchanging. They are calculated as a fixed percentage of the notional, much like the steady, predictable coupon payments from a bond. Whether you are the party paying this leg or receiving it, the cash flow amount is known for the entire life of the swap from the very first day. On the other side of the agreement, we have the floating leg. This is the variable component. The payment amounts on this leg are not fixed at inception. Instead, they reset periodically. For example, every quarter or every 6 months, based on the current level of an agreed-upon market reference index, such as TLREF for Turkish lira swaps, or SOFR for US dollar swaps. Now let's look at the risk profile inherent in each position, which is clearly outlined in the table you see on the screen. If you are the party paying the fixed leg and receiving floating, your primary risk is that market floating rates will fall. If they fall below the fixed rate you are committed to paying, you end up paying more than the prevailing market rate, putting you at a financial disadvantage. Conversely, the party on the opposite side, the one receiving the fixed leg and paying floating, faces the opposite risk. Their concern is that floating rates will rise. If the floating rate climbs above the fixed rate they are receiving, they are effectively paying out more in floating payments than they are receiving in fixed ones, making the trade unprofitable. This dynamic of fixed predictability versus variable market exposure and the corresponding interest rate risk is the core of every plain vanilla swap transaction. Now that we understand the structure, let's look at the practical application of a plain vanilla interest rate swap. The swap's power lies in its ability to convert interest rate exposure without ever touching the underlying loan or asset. We can summarize the reason for using an IRS into two primary categories: hedging and speculation/asset conversion, as shown in this table. Let's first look at the most common application, hedging. Imagine a corporate treasury with a floating rate bank loan, say TLREF plus 300 basis points. This creates payment uncertainty, which is a major risk for budgeting. To solve this, the company enters a swap where they pay fixed and receive float. Result: the floating leg they receive from the swap perfectly offsets the floating interest they pay on the bank loan. All that is left is their obligation to pay the fixed rate on the swap. They have successfully converted their uncertain floating liability into a certain fixed cost. This is the core function of corporate hedging. On the opposite side, we have the investor or trader using the swap for asset conversion or rate speculation. For asset conversion, an investor might hold a fixed rate bond but want to receive floating income. They would enter a position to receive fixed and pay float. The fixed payment they receive from the swap converts their fixed asset income into floating exposure. For speculation, a trader might believe floating rates are about to fall. By entering the same position, receive fixed/pay float, they profit if the floating rates drop below the fixed rate they are receiving. In summary, the IRS is a highly flexible tool. Whether you are using it to lock in fixed cost certainty for Treasury or to gain targeted rate exposure for a trading desk, the underlying mechanism is the same: the exchange of cash flows based on the notional principal that is never exchanged. This slide summarizes the essential contractual parameters, the conventions, that define any plain vanilla interest rate swap. You must agree on these details before a fixed rate can even be quoted. First, we define the scope. The currency dictates which market's conventions we must follow, meaning the benchmark rate and pricing curve. The effective date is when the swap starts accruing interest, and the maturity date defines the term, or tenor, of the contract. The fixed leg details are critical. The fixed leg frequency determines how often that fixed interest payment is exchanged, typically semi-annually or annually. The fixed leg day count convention, which could be something like 30/360 or actual 360, is the exact fraction of the year used to calculate the precise cash flow amount. Next is the floating leg. We must agree on the floating leg index, which is the market benchmark, such as SOFR. Like the fixed side, it has its own frequency for resetting and exchanging payments, and its own day count convention, which is usually actual 360 or actual 365. Finally, the business day convention specifies how we handle payment dates that land on weekends or holidays. The most common is modified following, which ensures payments are made on the next available business day, but prevents them from rolling into a new month, if possible. Once all these parameters are set, a dealer can then calculate the market price and quote the single, final, fixed rate that makes the swap initially zero value.